Good morning, everyone, and welcome to the Bipartisan Policy Center. My name is Dennis Shea, and I lead the J. Ronald Terwilliger Center for Housing Policy here at BPC. Recognizing the foundational importance of housing, the Terwilliger Center works every day to advance bipartisan policies that promote greater housing affordability and access. Today's event will explore the rise of institutional investment in the single-family rental market, an issue that has received considerable attention here in Washington and in certain areas of the country. Following the 2008 financial crisis, large private investors began acquiring and converting groups of single-family homes to rental units to meet evolving market demands. In the following 17 years, these investors expanded their portfolios. According to a recent report from the U.S. Government Accountability Office, the 5 largest institutional investors went from owning less than 5,000 homes in 2011 to roughly 300,000 in 2022. Private investment can certainly help communities preserve essential housing supply, but some observers contend that large investors in the single-family rental market are driving up costs and making home ownership less attainable. To help guide us through this thicket with the goal of shedding some much-needed light on the issue, we are pleased to welcome a distinguished panel of experts. I'm going to start in the middle. That's Don Mullen, is the founder and chief executive officer of Pretium, a leading alternative investment management firm with over $59 billion in assets under management. Prior to founding Pretium in 2012, Don held several key leadership positions at Goldman Sachs, including serving as a member of the management committee and leading the security division's global credit and mortgage businesses. Don also held senior leadership roles at Bear Stearns and is an active member of the development board at Yale University, where he earned his bachelor's degree in economics. To my immediate left is Laurie Goodman. She is an Institute Fellow and the founder of the Housing Policy Center at the Urban Institute. Before joining Urban, Laurie spent 30 years as an analyst and research department manager at several Wall Street firms. She began her career as a senior economist at the Federal Reserve Bank of New York. She has a bachelor's in mathematics from the University of Pennsylvania and a master's and PhD in economics from Stanford University, which that's shorthand for saying she's really smart. Rounding out the panel is Alexander Herman, who is a senior research associate at the Joint Center for Housing Studies of Harvard University, working on projects relating to housing markets, demographics, and housing policy. Prior to joining the center, Alexander worked as a grant writer at a Detroit nonprofit providing housing and treatment services to homeless populations. And Alex received a master's in public policy and a master's in urban planning from the great University of Michigan. So I want to thank everyone for participating in today's panel. Before starting our conversation, let me remind our virtual audience that if you have any questions for our guests, you can post them to our Twitter X account at BPC_bipartisan using the hashtag BPCLive. You're also welcome to submit your questions in the YouTube chat. Our in-person audience can submit questions via the QR code available throughout the room. I'm just amazed by all this technology. So we're going to start with Alex. Alex, for some level setting. I know the Joint Center closely monitors the U.S. housing market, and it does so extremely well. Can you give us a quick overview of the single-family rental portion of that market? What percentage of the rental market overall consists of single-family rentals, and where are they located?
Great. Well, thank you, Dennis, for that question, and thank you for having us. It's an important conversation to be having right now. There's been a lot more attention on this space over the last handful of years, especially as large institutional owners move into it more. But I think there's a lot of misunderstanding about what the sector is and how big it is and how much bigger it is than what is owned by institutional investors. So at last count, there are about 14 million, a little more, single-family rental homes across the country. Those homes comprise about a third of the rental stock overall. Who do these homes serve by and large? Because they're much larger, because they have more bedrooms than traditional apartment buildings and apartment structures. They serve a lot more families, a lot more larger households, and especially a lot more families with children. And I think you asked where these homes are located. I think what the institutional investor owned stock tends to be concentrated in select markets, especially in the Sun Belt, with pretty rapid growth characteristics. I think it's something we'll talk about a little bit more. But the single family rental space overall is kind of just everywhere. Like I said, it's a third of the rental stock overall, but it tends to serve communities where there isn't nearly as much rental housing. So the rental sector overall, single family rentals comprise about 45% of rental homes in rural communities, about 35% of rental homes in suburban communities, and even a quarter of the rental stock in central cities and in urban areas. Single family rentals are also a higher share of the stock in lower poverty, higher opportunity areas as well. So that gives you a bit of an overview of what the sector looks like.
Well, thanks, Alex. Now, building on that, Laurie, I know you've led several studies on institutional investors in the single-family rental space, including classifying and identifying the characteristics of these institutional investors. Can you expand on Alex's overview and when it comes to investors?
Sure. Well, thank you very much for the question, and thank you very much for the invitation to be here today. It's important to realize that there is no standard definition of a mega investor or an institutional investor. CoreLogic defines a mega investor as one who owns 1,000 homes or more. Freddie Mac defined a mega investor as 2,000 homes or more. We at Urban define it as owning 1,000 homes or more and operating in at least 3 distinct markets. So we found that in 2022, there were 32 such investors who together own about 446,000 properties, or 3% of all single-family rentals. As Alex mentioned, the holdings of the institutional operators or the mega investors are very concentrated. The 20 largest MSAs, as measured by the operations of mega investors, contain 80% of their properties. Most mega investors hold large numbers of homes in key markets in the Southeast and Southwest. These markets include Atlanta, Phoenix, Dallas, Charlotte, Houston, and Jacksonville. Atlanta is the single largest market for most institutional investors, with 72,000 institutional rentals in 2022. So there, institutional investors own 27% of single-family rentals in Atlanta, or 9.3% of all rental properties. In the top 20 markets, the mega investors own 12.4% against an overall 3%.
National.
3% nationally, so basically concentrated in certain markets. These markets, as Alex mentioned, tend to be fast-growing areas with large amounts of migration, large amounts of employment gains. These are the areas targeted by institutional investors because, as a business decision, you want to target a fast-growing area to expand. Mega investors within the single-family rental market, mega investors tend to buy newer properties in the markets in which they operate. The top 20 MSAs have a year built for all single-family rental of 1979. Mega investors have a year built of 1998. Buying newer, more homogeneous product allows institutional investors to better realize economies of scale. Mega investors tend to buy homes that are larger than most other single-family rentals. 37% of all single-family rentals have 2 or fewer bedrooms, only 6% for mega operators. These larger, newer homes tend to be located in census tracts that have above average income for renters, again, picking up the point that Alex made. Um, it's important to realize that institutional investors tend to purchase homes that need repair. Lately, many of the acquisitions for institutional investors have been build to rent. However, for homes acquired through traditional channels, in, homes they tend to buy you tend to target homes that need repair. Invitation Homes and American Homes for Rent have indicated in their 10K that they spend $30,000 to $40,000 to renovate a home acquired through traditional channels. Pretium and their sustainability reports indicate a similar investment, and I know we're going to talk more about this later. But it's important to realize that institutional investors do tend to target homes that need repair because this is where their comparative advantage lies.
Thanks, thanks, Laurie. So, Don, you're one of these mega investors.
Yeah, I didn't know I was going to be mega anything. So this was new information that I was mega. And next time, guys, you're allowed to bring the answers to the questions. So can we do that, please?
Well, let me get.
I mean, I have this, but I didn't plan to look at it, and it's all data. Go ahead.
So, Don, you heard Alex, you heard Laurie. You can feel free to respond. I know that Pretium understands the appeal of single-family living, especially for larger households and families with children. I know, talking to your team, that Pretium strives to purchase homes in communities that offer their renters greater access to higher quality schools and amenities. So how does Pretium decide where to own and operate these rentals? And how have you analyzed how Pretium's neighborhoods compare to other rental options in those markets?
Sure. Certainly a mouthful, and there's a bit to jump off from your comments. So let me say first that we built this business very much focused on being in a position that the assets we would acquire would be aspirational for the residents. And so as a result, we'd have an alignment of interest that we'd want them to stay as long as possible. And so our goal was to have assets in communities that had good school scores, moderate commute times, and low crime rates. That was our target acquisition. Folks say that we have, in the acquisition of said assets, a material advantage versus the average consumer or purchaser of a house. Some of that, as Laurie points out, is the fact that the mortgage system today is incredibly ill-designed for anyone to buy a house that needs 20,000 of repairs. Almost impossible. We institutionalized post-GFC the fix and flip business. So you're not going to have anyone who hopes to move into a home have access to capital. Like when my dad bought a Cape Cod in 1969 in River Edge, New Jersey, after we moved out of a rental two-family house, he borrowed the down payment from every member of the family and then we were able to get a very large loan, right? So we were able to do rehabilitation, though we'll say it took 3 years to do the bathroom, right? 3 years, he did it himself. You can't, that's not the way the world works anymore, right? So those houses that need $25,000 or $30,000 or $40,000 of repairs, they struggle to clear the market very often. And so as a result, what you find is institutional buyers will be the buyer of that, or an individual mom and pop who has excess capital, because that house needs someone to come in and clean it up. It could be a fix and flip investor who will then put it back into the owner occupant stock, or it could be us, where we end up renting that house in the community I described, which is, again, an aspirational community with opportunity. And then the renter can raise their children in a community that normally, historically, wasn't available to a renter. And so we look at our residents as us having a great alignment in their path to be in a position where they can eventually have homeownership, but raise their children certainly in a community of homeowners. That the data would imply that people raising their children in communities of ownership with good schools and low crime rates, their children do materially better. And that's what we look for when we make acquisitions.
Great. I mean, speaking of communities of opportunity, the Terwilliger Center is strong support of the Housing Choice Voucher Program because if it works right, the program works right, people have an opportunity, lower income folks have an opportunity to move into a community with more opportunities. I know that, Don, Pretium's Progress Residential manages more than 2,700 affordable rental homes, many occupied by families that use vouchers. Why does Pretium participate in the Housing Choice Voucher Program, and what are the benefits, and how would you improve the program?
Sure. I'm always want to improve federal policy. That's my favorite thing to work on in any given.
That's what we try to do here at BP.
That's your job, not mine.
Yeah, right.
With that being said, listen, we had an opportunity when we were asked by the federal government and the city of Atlanta to help them with a program where they had a condemned public housing project. And there were families that they couldn't relocate, in part because they had too many children relative to the size of available apartments. So they sort of grew out of being readily moved from one to the other. We were able to provide them with a large choice of houses to move people in and accepted vouchers for that move. We actually found it to be a great opportunity to help people and a very good opportunity for our investors. And so when we looked at it, we said, this is a program that investors who want to feel like their capital does good things can earn a reasonable return, and we can put people in better communities and where we see a lot of other similar housing opportunities for that cohort of Americans. And so we very excitedly are beginning to build a business. We've invested about $1 billion. I always yell at my people when they say spent. We invest, we don't spend. We invested $1 billion so far. Our expectation is that we will invest many billions of dollars in participating in the voucher program because a great portion of that vouchers go unused every year. So the goal is to have Americans who have vouchers living in communities of opportunity in single-family homes where they have the same opportunities we talked about, our renters who can afford to live in those communities, low crime rates, good school scores, and moderate commute times. And we think that we can deliver that. That being said, one of our advantages in delivering it is the high complexity. Yeah. You think buying one house at a time, we bought 60,000 houses, one house at a time, and operate them in scattered site. The ability, that would not have taken place in 2000, independent of house prices, because the technology to do that was unavailable. Mm-hmm. The technology today is so cheap at the margin. I'm not talking about AI, I'm talking about workflow, the ability to alert individuals, to drive trucks and deliver service. All of that is off the shelf. And we just need to sort of build programming or an API on top of that. So as a result, when we look at housing choice vouchers, it's kind of a mess. Mm-hmm. The complexity is unnecessarily large. That doesn't mean, I'm one of those people that are just going to criticize bureaucrats. I'm not. Every part of the complexity is well-intended. It's extremely well-intended for the goal to have the community have input into the program. What that does, though, is it shrinks the units of capital that will be able to execute on it unless someone builds a workflow technology that takes the 30 most important organizations, maps their attributes, and then can use a tool to define what assets in that community fit the characteristics that the local housing authority wants to execute on. That's not mom and pops are doing that anytime soon. So while people like to complain about our scale, the implementation of technology and the ability to execute local rules and laws at scale can only take place from an organization like ours.
A lot of folks, mom and pops and others, landlords, not institutional investors, complain about the inspection process for the housing choice voucher as being unduly complex. And if you have to forego 2 months' rent to get the inspection done, that is a strong disincentive to participate.
Certainly, and for us, we had to build it into the model, right? And we had to alert investors that you're going to have a different return profile and a different cash flow profile because of it. So we can bring that kind of capital to bear that moms and pops might not otherwise choose. That being said, one of the biggest challenges that we have in all of these things when it comes to regulatory agencies is, we live in an era where technology is moving so quickly, so rapidly, that it's in all of our interest to be in a position to wisely implement, because speed can make a difference in someone's life who's the resident. Getting into that asset quicker, particularly when they're moving into an area of higher opportunity, we can't go fast enough, right? And so there's a lot of opportunity for technology to substitute for not the inspection not occurring, but the inspection occurring in a manner that's more timely and done potentially remotely.
Thank you. So we heard about Don's father's remodeling experience. So let's talk about remodeling. Alex.
We had 2x4s with plastic stapled to it.
Okay.
And my mother lived in horror. We weren't allowed to have a guest to the house for the entire 3 years of the bathroom repair. Plus also, old school, 5 people, 1 bathroom, right? Lots of folks live that way. But
That was me too.
I hear you, right?
Right.
And so, we had like a timer, a kitchen timer outside on the floor of the bathroom. And when that ding went off, you get your ass out of there because you were not allowed to be in.
8 a.m. was definitely a bad time to be.
Totally.
Right. So
I had hair back then too, so it took longer,
So Alex, the Joint Center does great work. They issue a lot of reports. One of the reports that they issue is called "Improving America's Housing." It was released last month. It highlighted the continued strength of the home remodeling market, which remains 50% above pre-pandemic levels. How do the findings of this report relate to institutional investors in single-family rentals?
Yeah, no, I think there's an incredible opportunity there. And for some of the reasons that we've already touched on, as Don said, his company, right, has the capacity to handle the complexity of something like housing choice vouchers. In the same way, there's capacity to remodel, renovate the stock, maintain the stock on an ongoing basis. So I think there's 2 components to this. One is the challenge and one is the capacity. So thinking about the challenge, which I think is highlighted pretty well by that report, the housing stock in the US overall is old and getting older. So what that means, right, is there's a need to retrofit the stock for energy reasons. There's a need to improve accessibility, especially as the population continues to age. But at the same time, there's also just a need to maintain and renovate the stock to ensure its suitability going forward, to ensure its livability going forward. And that's especially true when you think about the supply crisis happening in the country overall. You, of course, need new construction, but you also need to maintain the stock that you have. So to put some numbers on it from the report itself, I think the median age of the housing stock overall is 44 years old, right? Which, of course, means about half the stock in the country is a half century old. The rental stock is even older. And then within that, the single-family rental stock is older still, right? I think a fifth of the single-family rental stock was built before 1950.
And the single-family stock in New England is the oldest, right?
Well, yeah, you could continue to break it down and get even, absolutely. So what can players like Don do? They have the capacity, kind of as previously mentioned. So there's an opportunity. And they have the capacity. So Lori touched on the acquisition strategies. What kind of capacity can they bring to bear here? But there are important ways. It's important to think about what these companies are. And I think Don touched on some of this. These are tech companies, logistic companies, platform companies, right, at the end of the day, who bring scale to what has been traditionally a very difficult scattered site rental market. Those scale efficiencies play out in property management, but also in terms of renovating and maintaining properties. Lori mentioned, right, acquisition strategies, which we could talk more about, and identifying properties that have a particular value. But there's other ways in which these companies can bring scale to market in terms of, and the ways that that's done. I think include investing in standardized building products, investing in standardized building systems, investing in standardized appliances across the property. And what that allows, for example, is to buy much larger inventories at a discount in a lot of cases. You can negotiate extended warranties with some of those companies. And you can also train your maintenance staff, your servicing staff, right, to at the same time install and work on those homes and those building elements kind of on an ongoing basis. Folks like Don also, because they're such big players in a lot of the markets that they serve, can also at the same time negotiate with contractors to do this. Lori mentioned some of the 10Ks for these companies. I looked at some of the same things. You see, even when they acquire a home, in a lot of cases, even when those homes are relatively new, they're investing immediately $20,000 to $40,000 in that home. And in some cases, just to put in some of the standardized building products that we've mentioned, or that I mentioned. But more than the invested amount, it's also that turnaround time. And Don mentioned that they can get that renovation, that remodel done in a couple of months, right? And that's something that wouldn't be available. So yeah, I think there's a real opportunity there because of that capacity, because of the challenges that we face.
Thanks, Alex. Laura, let's go to one of the criticisms of institutional investors. And they're often criticized for outbidding potential individual buyers, especially potential first-time home buyers. What has your research discovered on this topic, and are there ways to mitigate any potential impact on first-time home buyers?
Yeah, so, when people look at the areas where institutional investors are the largest, they do tend to be the areas with the most robust home price appreciation. And therefore, they conclude that institutional investors cause home price appreciation by outbidding first-time home buyers. However, correlation is not causation. Institutional investors target fast-growing areas with employment gains and robust rental increases. It's basically you want to target areas where there's going to be huge inflows of population, huge employment gains. It's part of the acquisition strategy. In addition, you want people, not everyone can afford to be a home buyer. You've got people who have incomes a little bit too low. With today's tight credit box, you've got a lot of people who don't have the necessary credit score. One of your competitors actually did a study that showed that 85% of their renters could not have been home buyers, either because of credit score or income. But these are families that wanted a single family home in which to live and raise their kids. Also, it's important to realize that homes that institutional investors target are oftentimes different than those targeted by first-time home buyers. We've talked about the importance of repairs, and I just want to sort of very quickly make the point that institutional investors have three big advantages when they're buying homes that need repair. The first is they know how to efficiently do repairs, and Don made this point. They won't be upsold the way I am currently being upsold on my kitchen renovation. Your guys would be horrified if they knew the price tag on that. You're able to institutional investors are able to realize economies of scale, and Alex made this point. They're able to negotiate a discount for labor based on the volume of business they give the vendors. They negotiate discounts on paint and carpet. They negotiate discounts and extended warranties for products commonly used in the renovation process, including appliances and air conditioning systems. And the institutional investors usually pay cash for their properties and can finance their purchases later through the securitization market or through lines of credit from a bank insurance company. By contrast, owner-occupants generally need a loan to do repair. And Don made this point that mortgages are not designed for major renovation, usually because loan amount is based on current property value. If you want renovation financing based on the after repair market value of the property, it's cumbersome, more expensive, and has a really high denial rate. The denial rate for renovation loans in 2023 was a shocking 43% versus 10.6% on purchase loans.
Not to interrupt you, but I presume that the acceptance rate probably has a lot of equity in the house. And when you originally purchased a house, you have very little equity.
Yes. Yes. And yeah, I mean, basically renovation, you tend to do the renovation loans when you're, over, when you have high LTVs and you need that after repair market value of the property, but it's really shocking. So why would, so if you were, so if I was gonna, so if Don has a choice when he's selling his home between a cash investor or me who needs a renovation loan with a 43% denial rate, it's just very, very discouraging. So we really do need to think about the renovation financing system in this country. So what can institutional investors do to encourage home ownership? When they sell properties, they can give current residents and nonprofits a look. This might not be possible if you're doing a portfolio sale. But I do want to mention that more recently, institutional investors have turned heavily to build to rent, which doesn't take any homes away from existing home buyers. And in fact, it adds to the supply of homes, which puts downward pressure on both home prices and rents and is just additive to the housing stock.
Thanks, Laurie. So Don, on the home ownership point, I know Pretium has implemented several initiatives to help transition rental homes to owner occupants. The company has launched a pilot First Look program with community-based nonprofits in Atlanta and the Twin Cities. Can you tell us about these efforts and working off Laurie's question about rent to own? Do you tell us about what you're doing on rent to own?
Well, we covered a lot of topics. So let me give first a little bit of context.
Sure.
I think when we talk about Pretium, I'm sure everybody here, by the way, it's the root word for value in Latin. Didn't make up some French word. We were just trying to figure out how to name this place, not after a park that I live near or a stone or a black tree or a red oak or something like that. So I thought something functional would make more sense. But with that, the whole organization has many insights into this marketplace. Let me give you a handful of them. One, we're one of the largest lenders to people who do fix and flip in America. So that's not institutions, it's moms and pops who are going out and buying houses that otherwise are very hard for a prospective homeowner to live in because of the amount of repairs that needs to be done. So one of the largest lenders in that space. We're also one of the largest non-bank lenders to home builders in the United States today and growing very fast as banks recede from lending money to anyone but the top 10 home builders. Okay? We're also one of the largest non-QM lenders in the United States. So that's people who don't qualify for the Fannie Freddie box, that's a QM mortgage. We lend and underwrite bespoke underwritings, which was pretty much abandoned after the GFC. There's a handful of people who do that. We do that as well. We also manage apartment buildings in many markets in the United States, as well as our single-family rental business. So we have lots of insights into what we see the opportunity in the marketplace today. So to go back to your question, in the context of what we see, we very often are trying to strive to sell houses when we're, in particular, selling houses, first to the resident in the house. And then we're offering them in our First Look programs, both to the resident and to not-for-profits in that community to help facilitate the ability for people to live in that community or for not-for-profits to help other people potentially live in that community. So far, I will tell you, we've had very modest take-up from residents because of exactly what Laurie said. The reality is, if it's 85%, I think that's low. I think the average person living in our houses cannot purchase a house, not because of prices, because of FICO scores, because of debt, and income to house price ratios as well, certainly. And so I don't think when we talk about institutions owning houses, we have residents who are living in better communities than moms and pops could afford to purchase and generate a return because of the efficiency described earlier, because we buy our fridges from Samsung. We don't buy them from Lowe's, you know. We buy the same beige paint, but the truck. And so all of that allows us to deliver a better house and a better community for a resident who will never be able to purchase a house as far as we can tell, right? And so that's not house price, it's FICO score. And the mortgage system is designed to limit their access to owning houses. So we try to sell houses to residents, but very few of them can actually afford it. We end up selling to not-for-profits, and we're very aggressive in trying to work with communities to improve access to housing, because all of the communities we're in, we think residents do better and have better outcomes if they're a renter in an ownership community than a renter in a rentership community. And that data isn't ours, it's from Harvard, it's from other places, that renters in ownership communities have better schools, lower crime rates, and a greater opportunity to escape intergenerational poverty. You made some other comments too about the systems that we have for the executing of this. We started out with the first 60,000 houses, one house at a time. And as Lori pointed out, our peers and ourselves are pretty much out of that business. One is homeowners today will pay more than institutions. The average homeowner is willing to pay much more than an institution economically. It's also, let's be candid, it's politically toxic for us to go out and buy a house that's scattered site, even though that's the best outcome for a resident. So there's clearly, in my opinion, in the public dialogue, a bias against renters. It's sad for me, it's good business, but it's also, we really do help people, and they end up with better opportunities for their kids, but the ownership bias is so powerful that I think it hurts the opportunity for people to move up and move out by renting in better communities.
More than 1/3 of the households in America are renters, so it's an
Right.
important element of housing.
Yeah, and it's very hard. Multifamily is not generally located in places for good schools with low crime rates. It's just not the right outcome. So we buy new houses, like we said, built to rent, which will be an interesting experiment because they're not ownership communities, but they are amenitized, they are attractive, many of them. I've seen them go bad and I've seen them go very well. We buy houses that home builders can't sell. We're like the balancing mechanism for home builders in America, and some of our peers are too. I get anywhere between 10 and 30,000 houses a week that home builders can't sell, that they want me to look at and buy. So we're the balancing capital in that system too.
Fascinating. Did you have?
Yeah, just to emphasize a point that Don made, a colleague of mine has coined the term rental deserts that she's written
Yes.
about a bit, and it's where less than a fifth of the stock in any given neighborhood is rental housing. If you look at those rental deserts, this is in some ways a tautology, but 2/3 of the rental properties that do exist and are already limited are single family homes, right?
Yeah.
So these are places where rental housing just would not exist otherwise. They're single family rentals.
But great opportunity, a great opportunity community for a resident there.
Yep.
So rental deserts, how about data deserts? You know, as I researched this topic in preparation for this webinar, I realized there's not a lot of timely data on the subject. So Alex and Laurie too, if you wish to add, what are the key gaps in the data set that need to be filled?
Yeah, there are real challenges. Thinking anyone who's, Lori knows this, looking at rental housing, looking at rental markets, there's a very real lack of publicly available, high quality, frequent, good, just data in general. And that extends along a number of lines and extends into property ownership and knowing anything about property ownership. So you have entire kind of academic subdisciplines, many of whom aren't as friendly to Don maybe as he'd like, looking at and trying to identify who property owners are. And as anyone has looked at property records to try and identify who owns housing, who owns rental housing in particular, it's a major challenge. There's all kinds of issues looking at that. So thinking two things, what do we as a research center and what does the academic community need to do? And what should the federal government do? What should state and local governments do to kind of improve upon the data infrastructure we have? One, as academics, and there's work already being done. There's a lot of sharing, but more can be done around sharing code, sharing strategy, sharing means of identifying but also making the tools to do that more accessible to folks and putting out the data that has been produced and getting it out into the public in a more concrete way. Part of the problem is these records look different across the country, right? So I think this is where governments can kind of step in and start to think about what data needs to be collected and how frequently. And the feds could play a role in this potentially, right? Thinking about what actually needs to be done and what state governments and local governments should do to get that out there. And then also just to point, there are some existing surveys that could be expanded. So the rental housing finance survey conducted by the Census Bureau asks some questions around ownership, but it's a limited survey. It only comes out on a pretty irregular basis. It doesn't give you much insight into ownership in a meaningful way. There are things you could do to expand that survey to make it more useful for thinking about ownership trends. And the last thing I guess I'll note is it's not just about the mega investors, it's not just about institutional investors. It's ownership transparency across the board, right? It's mom and pop, it's regional landlords, it's the big guys also, right? So understanding how ownership matters for the rental market is really important, but there's a real need to bolster kind of the data around that.
I know, Laura, you want to add on to that? I know you've talked about maybe property ownership data through rental registries, improving property ownership data.
Yeah, I mean, I would love to see rental registries. I mean, I think the federal government should develop sort of a model rental registry that would help jurisdictions more quickly establish their own registries, and it would ensure that the data collected across markets is clear and consistent and would ease the burden on owners that operate across markets. It would give policymakers actual information on ownership and composition of the housing stock. This would have been really, really helpful when the federal government was trying to deliver emergency rental assistance during COVID-19. There were times where jurisdictions couldn't identify the landlord, and it would assure that renters know the ultimate owner of the properties and not just the name of the LLC. So yeah, I mean, I really like the idea of rental registries. There's been a lot of there are a number of people who really dislike large single family investors and have said, oh, well, let's just put some roadblocks in place so that these guys can't buy more homes. Maybe we should have onerous taxation. Maybe we should have fines. I mean, this is just absolutely terrible public policy because it says to the homeowner, oh, you can't sell to the highest bidder if that bidder happens to be an institutional investor. What you're really supposed to do is think about what kind of things institutional investors can do more easily than mom and pops, and sort of put more cost effectively than mom and pops to improve the tenant experience and put some and require those. So, for example, accepting housing choice vouchers, which Pretium and many other single family rental operators already do. There's clearly hassle and administrative costs associated with dealing with the local authorities. We made the point earlier that inspections can take time to arrange. The property may sit vacant for a couple of months. This is something that institutional investors can absorb far more easily than mom and pops. Require it. Security deposits and alternatives. Rather than requiring security deposits to be paid in cash up front, accept security deposit insurance or permit the renter to make the payments over several months, opening up access to more renters. Reporting rental payments to credit bureaus. It's a pain in the ass to set up, but once you set it up, it can be applied to
Done.
a
Pretty spicy conversation here.
Yeah.
Done. Did it. Lots of good outcomes for people.
Yes.
Handful
yes.
of people can buy houses because we did it.
But it improves their. But it allows people to build credit more easily.
Positive credit reporting was a critical first step for the industry, I think.
Yes.
We were the first. I think several other people are doing it now, but I agree with you.
But it's something that you guys can do cheaply and more efficiently.
Listen, I think your point's extremely well taken. The right answer to this, I know I sound very biased, is not to be in a position that you say go away. It's how do we work together
Together,
to
improve
improve
the tenant
housing
experience.
outcomes
Yes.
for all Americans. That's what is the right answer. We have found, look at banking. The reality of it is, whether we like it or not, we're going to end up with 10 banks. That's what's going to happen. You can tell me any other story you want. I won't believe it. Because every other country in the world ended up there, right? And we have spent trillions of dollars bailing out small banks that really can't operate in this world. We end up a better outcome if of the mega buyers, I don't like that phrase, but you guys are using it, right? Because we can be
Yes.
managed collaboratively with regulatory authorities for better outcomes. If I was running the government, I would rather have someone I can manage than the wild, wild west of 200,000 homeowners who don't follow anybody's rules but rent those houses. It's the wild, wild west out there.
So is that I mean, there've been proposals at the state and federal levels to restrict corporate ownership
I think it's
single-family
stupid.
homes. So that's your
I
response.
mean, not even as a capitalist, I don't say it's stupid. Outcomes for residents will be worse. Will be worse. Before we existed,
Yeah.
very few houses existed in opportunity communities. So when you make a decision this way, you're clearly saying you don't want people with 600 FICO scores to get out of bad neighborhoods and live in good neighborhoods. That's what people are saying. It's a rental bias that's really harsh for prospective residents, and you're condemning people that they aren't allowed to live in good communities.
Okay, thank you. Well, we got to go to audience questions. We have our first one here. What happens to investors and current residents of single-family rentals if an area limits or restricts institutional investors? Does anybody want to take that question?
Well, the pause would mean me. So
Sure.
I
got
think it
your name
depends on
written
the
on it.
manner with which it's executed. So if people say that they want us to execute a liquidation of the portfolio, it'll be devastating to prices in that community, devastating, because it does price a little bit at the margin. But I think more importantly, it'll be about the renters. Moving so many people out who can't afford, there's no housing stock in those communities. So if we manage to somehow sell off all our houses to owner occupants, which people would like, we would be forcing those folks into lesser communities at higher rents because we'd be moving a surge of renters into lower communities. It would be horrible for those families.
Laurie, do you have a view?
Yeah, no, I agree. It would be horrible for those families, and it's also, from the point of view of the sellers of properties in those neighborhoods. You're saying, oh, if you have a property that needs repair, you're not going to be able to sell it to the highest bidder. So you're restricting the ability of current homeowners to dispose of their property to the highest bidder as well.
You're creating a national subsidy for small renters. That's what you would do. You'd be taking that subsidy from extant homeowners and from the backs of renters and giving it to small business people.
Okay. I like this question because we too often don't pay enough attention to housing needs in rural communities. So how can rural communities leverage the benefits of institutional investments in single-family rentals while mitigating any risks? Any focus on?
Yeah, so I mentioned previously, right, that single-family rentals are about half of the rental stock in rural communities across the country. The one thing, and I don't know how productive this is, but I've been thinking about it as we've had this conversation, in areas where there might not be a market opportunity for folks like Don, how do we leverage some of the things we talked about, learn from the scale efficiencies that these companies can acquire on the property management side, the investment side, and transport that to places, again, where there maybe isn't the market opportunity, but there's a lot of need. So I don't know if that involves nonprofit institutions, nonprofit building, or what, but that's the first thing I think about.
Let me jump in and say, let's
Please.
go back to my analogy of banks, right? We have a whole bunch of rules that banks need to follow. And I know I'm using a bad example. I'll go back and my people say, you compared us to banks? Everybody hates banks. And now everybody's going to hate us even more. Nonetheless, we regulate banks in a lot of different ways where we say, you know, you have to make this amount of commitment to people in need of housing. You need to make this much to the community you're in. You need to, if our industry was bigger, not smaller, not being pushed out, you could say to us, you have a tax incentive to go into rural communities, and in those rural communities, we'd expect you to do this. You have a license to do this nationwide. As part of your license, we expect you to do this in communities of need. So you could create a checklist like we do with the banks to say, if we're going to be supportive of your industry, you need to be in a position that you make this contribution to communities. And this is one of the things that could be done.
Laurie, do you have anything?
I don't, nothing to add.
Okay. Here's one. How should communities, this rebuilding from disasters, treat properties owned by institutional investors, rented to local families when offering government grants and loans? Should affordability periods be longer than for other non-resident owners? Want me to repeat that? How should communities rebuilding from disasters treat properties owned by institutional investors, rented to local families when offering government grants and loans?
I'm not sure. I may have had too much coffee and not enough food today. Why don't I instead tell you what we do when we confront this? And I apologize. I keep sticking my hand in front of your face.
No,
I'm sorry.
that's quite all right.
I move my arms around a lot. So when we're in communities, and we've had this, you know, having a lot of houses in Texas and Florida, even though we specifically screen out houses in flood zones, we've had lots of experience. So what we do in these circumstances, first is, and again, it's an example of what an institution, we pre-position assets in the safest location, and then we roll them in before FEMA's there, we're there.
Really?
Yeah, because we have residents' lives. We do an inventory immediately. We email, text, and if we don't hear from you, we go visit.
So you know particular areas of the country which are disaster prone, and
we take very realistically our responsibility for people's lives and our assets. So one of the first things we're doing is a wellness check on everybody, right? And so if you don't answer our text and you don't answer our email and you don't answer our call, a human being will be at the door of that house finding out how you're doing. We reposition people where if we have to rent assets, whether they be hotel rooms or other houses, we move people out. Sometimes people don't want to. They want us to do the work, and it becomes a little bit of a circus, to be honest with you, because we want to do work in a safe place. But we work very hard to move our residents into places that are equal or better than they're already in. We encourage them to insure their belongings when they come in. And then we repair that house and try to return them to that house if that's what they want.
Great.
So we try to be very forward.
Historically, if you look at places that have experienced large disasters, it's much less likely that the renter-occupied stock ends up getting rebuilt in those places, right? One thing that I think institutional investors could play a major role, they're not foregoing, right, the opportunities that are out there to rebuild, right, that maybe a smaller property owner might not be able to leverage. And they could also, at the same time, adhere to some other requirements. So I think there's a balance you strike around what kinds of requirements, while at the same time ensuring that properties that renter households live in actually get rebuilt.
Well, to close this out, I'll ask you all the same question. If you could implement one major federal policy change today to support affordability in the single-family rental market, what would it be? Want to start, Laurie?
Sure. So basically, build, reduce, relax building codes, relax zoning codes, build. The more housing supply you have, be it homeowners or renters, the lower prices are going to be. It's just supply and demand. I demand 1 unit of housing if I'm an owner or if I'm a renter. And that unit of, and when I think about, sort of when I think about pricing, it's total demand for housing versus total supply of housing. And it doesn't matter so much if I'm an owner or a renter. And so if you build more, you have more supply, which drives down prices. And so it's relaxing building codes, relaxing zoning codes, improving financing in some cases. Those are the keys.
Let me build on that statement because you make a really important thing. But unfortunately, being old, I like to use history. So at the GFC.
You're not that old, Don.
Oh, that's very nice. Well, if we look at home ownership, I'm not that old, and I'll weave that into the sentence or concept. If you look at what's happened to this generation, the millennials, the recent household formations, families, they're the ones who are really suffering the most, right? If you look at home ownership among people 70 years old, it's 80%, right? And so what's going on? We absolutely positively had no planning. We're kind of that way as a country. We're really ad hoc, shoot from the hip, ready, fire, aim. That's our public policy. So what happened? We had a global financial crisis. We tightened up mortgage availability. Home builders and guys who make gypsum board and all that stuff shrunk their capacity. We went through this big hole of building. That was fine, right? For a while, it was okay. But the millennials were coming, and we weren't building enough houses. Then a second thing was happening that everyone should have figured out, but nobody ever thought of its impact on housing. People are living longer. We all know that. They're living longer and healthy, right? And so people are staying in their houses way longer than they used to. If I go back to 1990, there's a lot of data that shows home ownership tipping off. That doesn't happen anymore. People get up to whatever their level of home ownership is, right, in their generation, it stays flatlined at 80 till they're 75. So we have 15 years of houses stuck in the system that in any other generation would have been recycled back to young people. So we made it harder to get a mortgage. We took a whole crap load of houses off the market because old people kept them, like me, right? I'm 67, so I'm close to that, right? And then we underbuilt. Why should anyone be surprised? It's not us buying a little bit of houses here and there. It's fundamentally the system's off base. It's completely imbalanced. So public policy that encourages people after a certain age, tax advantage to sell would be great for millennials, right? Being in a position that we liberalize some of these very tight rules, and like, look at California, look at New York. We have very tight rules in those areas about development. California has the second lowest home ownership in the country. I wouldn't say that is a victory for public policy, right? For the two states that, listen, I consider myself a moderate liberal. Pretty liberal, really wanted to work for residents, complete failure working for their residents. We need to liberalize the development of housing, as Lori said. We need to encourage seniors to move out of their house in some orderly fashion, and we need to be in a position that our mortgage rules are at the margin liberalized, not a wholesale change.
Thanks for that, Don. Alex?
So I'd underline all of that from both Lori and Don, and then add something a little bit different, thinking about kind of the age of the stock and the needs that exist, especially on the single-family rental side. There's an opportunity, I think, to invest in the stock, both kind of on the supply side and on the demand side, to improve affordability, right? So challenges of an aging stock, of course, but utility costs are also a non-trivial part of affordability for single-family renters. And especially in older single-family homes, but in single-family homes overall, utility costs are greater, right, than they are in other parts of the rental market on the multifamily side. So encouraging, right, use of different tax credits on the rental side, things, ways to boost and make improvements on insulation, maybe solar installation, modernizing windows, central air, things like that are really important. And then on the demand side, funding lower income households with their utility bills. I think those are two kind of modest improvements you can make on affordability, though over the longer term, it's the supply challenges that you need to address to really
I would add one thing, because I talk too much, is you need to be aware that we're looking at another challenge coming. No one's talking about, we didn't mention here, property taxes. All of these houses going up in value are not just hurting the investor who's now trying to rent it, and that's pushing rents up. We're taking homeowners who could afford their houses and are increasingly going to be not be able to afford their houses because of property taxes and insurance. And so one of the things that we
Particularly
can
people
do
on
is that
fixed incomes, the older folks.
we need to be in a position that we have nationally address how to create reduced tail risk for insurance companies so that they can write more insurance, because otherwise they are going to shrink from all the communities that have major catastrophic risk, and the prices will cause defaults from extant homeowners.
Okay, well, Don, you get the last word. Let's thank our great panelists, Laurie Goodman, Don Mullen, Alexander Herman. Can you give me a round of applause? That'll be it for the day. Before I go, I want to encourage everyone, particularly our substantial virtual audience, to go on bipartisanpolicy.org and register for our upcoming Summit on Housing Supply Solutions, which will take place on June 18th at historic Union Station in Washington, D.C. Registration is free, so please join us for that day. Again, I want to thank our panelists. I want to thank our virtual and in-person audiences, and I wish everybody a great day. Good night. Bye-bye.
Nice to see you.